Okay, so now we covered balance sheets and looking at companies, so obviously that's going to cover the first thing here, and this is a slide essentially on how and where to invest, okay? So we covered blue chip stocks. You already know what those are, right? That's like your reputable companies that you can invest in long term. Now, one of the benefits of investing in an individual company is there's more upside if you're picking your companies well, obviously, because the company can grow a lot faster than the entirety of the market. So if you're going to invest a little bit more safely, then and this is something I love, so I invest the majority of my money into ETF and mutual funds, but I also take some risks on some companies that I really believe in, and I believe in long term, and obviously they go off that balance sheet checklist. So if their balance sheet looks good, I believe in the company and what they're doing. Potentially I like their products, and that's not always an indicator, obviously. You don't want to use that, but just something that I look at. Then obviously I will invest in companies as well. Now I'm currently only invested in 3 companies outside of ETFs and mutual funds, so the whole thing with diversification, you can do it within your ETF or your mutual fund, which we'll cover what that is here in a second. But I wouldn't recommend diversifying with your blue chip stocks, right? People hear like, oh, diversify. But realistically, what you should do is you should really know a lot about a few companies and invest in them. And then also invest in ETFs and mutual funds and use that as your form of diversification. When people hear diversify, they usually think like, oh, I'm going to invest in 50 different stocks because I want to be diversified. And that's just, it's not the way to go, okay? So diversification can be implemented in a number of ways, but I don't recommend that you do that. So blue chip stocks, obviously, that's where you can invest, number one. It's a little bit more risky, for lack of a better word, even if you're buying into more reputable blue chip stocks and companies. More risky compared to ETFs and mutual funds, which are a little bit more safe, for lack of a better word. Now, what is an ETF, you might ask? What's a mutual fund? Well, to put simply, an ETF is a basket, and ETF stands for exchange traded fund, if you didn't know. All it basically is a basket or collection of securities or stocks that tracks an underlying index, okay? So put simply, an ETF is a collection of stocks that you're buying into instead of just one stock. Now, it's a little bit less obviously advantageous and a little bit less of an upside, but a lot less risk because you're kind of diversifying over a fund or an ETF in that specific example. Same thing with a mutual fund. So it's a little bit less upside, like I said, but a little bit less risk, obviously, or really realistically a lot less risk. Now, if you want to be a little bit more on the safe side and conservative, and you tend to be a little bit more conservative like myself, I love ETFs and mutual funds because it's almost a sure thing. Now, it will go up. There will be years and months that your ETF or mutual fund goes up or goes down, so you need to understand that. But typically, on average, like I said, 6 to 12% is what you can expect compounded every single year in the stock market. So that's an ETF, obviously something that I recommend that you look into heavily. Now, a mutual fund, roughly very similar. It's an investment program funded by shareholders that trades in diversified holdings and is professionally managed, okay? Now, basically, these two are obviously more safe, for lack of a better word. They're safe ways to invest into a variety of stocks at once that you can get the benefit of being in the market, obviously. So you're getting that 6 to 12% on your money, which you obviously wouldn't get in a savings account, and obviously investing with that compound interest, but also get the benefit of mitigating your risk. And this is super important, mitigating your risk, because your investments are not just tied into one company, unlike a blue chip stock where you're just investing in that company, okay? So that's what I recommend. I would say, if you're more conservative, go a little bit more with ETFs and mutual funds. If you're like, if you're young, especially, or if you like a little bit more risk and a little bit more higher upside, then obviously go into blue chip stocks. But I would never recommend just being all into ETFs or all into mutual funds or all blue chip stocks specifically. I would kind of do a little bit of both. But, for me specifically, I don't know the number. I'd have to look at my specific portfolio depending on where I'm actually investing in it. And we will cover where I actually invest, the 3 platforms, later on in this course. But me specifically, I would say probably I have about 70 to 80% of my investments into ETFs and mutual funds, and about another 30 on, blue chip stocks that I believe in. Now, another thing that you can invest in is a Roth IRA or a 401k. Now, I'm going to cover what both of those are in a future lecture and break down the positives and negatives of them. Put simply, just to kind of give you a little bit of background on them, they're both retirement funds. So for a 401k specifically, the benefits of that are you're investing your you're investing your pre-tax income on a 401k. So a lot of people will have employer match on a 401k if they have like a career or a 9-to-5 job, right? And obviously, if you have employer match, you should be maximizing that employer match because it's free money to invest, okay? That's first and foremost. So a 401k is you're investing your pre-tax money that comes out of your paycheck before you get it, and then you will be taxed on that later when you cash out for retirement, okay? Now, the benefit of that is obviously you have more money to invest because you're investing your pre-tax money, and you get employer match a lot of ways, or a lot of times with your employer. So those are two benefits, because obviously if you have more money to invest, the more your money is going to compound, right? A Roth IRA, on the other hand, is something that I have. I don't have a 401k because I'm an entrepreneur, although I could get one. The reason I don't have a 401k is because I don't have an employer, right? My employer is not matching my 401k, so I don't have a 401k. I have a Roth IRA, okay? Now, currently speaking, you can only invest $6,000 into a Roth IRA per year, but you can also open up just a normal IRA if that's something that you want to do and look into as well. But for a Roth IRA, you're investing your post-tax income, okay? So money that's already been taxed. So let's say, hypothetically, before you get a paycheck, obviously your money comes out and goes into your 401k, right? Pre-tax. But with a Roth IRA, if you weren't an entrepreneur, if you had a 9-to-5, you would get your paycheck, right? Your taxes have already been taken out for state, local, and federal, right? And then obviously you're investing your post-tax money into your Roth IRA afterwards. So the benefit of that is you're locking in your tax rate now, because clearly tax rates obviously go up over time. The drawback, however, is you have less money to invest because you're investing your post-tax income that's already been taxed, right? So you have less money to invest, which means less potential compound interest over your money over the long haul. So that's my brief summary of, Roth IRAs. Obviously, when you cash out a Roth IRA, later on in life when you actually retire, you will not get taxed on that money. So it's just one lump sum. You're not taxed on it because you have already paid your taxes on that money, okay? So that's my summary of Roth IRAs versus 401ks. Obviously, you can Google it, look into it a little bit more. I am going to have a specific lecture kind of summarizing them at a later point in this course. But realistically, if to put it simply, if you have employer match and if you have a 9-to-5 or a career, you should have a 401k. If you don't, and you're an entrepreneur, probably more advantageous, generally speaking, to have a Roth IRA, okay? Now, high interest bonds are another place you can place your money. That's a little bit less risky, obviously, but you're not going to get as good of a return on your money. You can look into higher interest bonds if you're interested in that. But there's also, I put etc. there because there's many other ways to invest, like some things that you might not think of that are investments, and I don't recommend these, but I'm just kind of trying to broaden your thought process and your horizon. Are cars. You might think like a car's not an investment, but if you buy the right car that's already depreciated and it's like an exotic car or like a car that's rare, that car will typically hold its value and sometimes even increase in value over time. Another example of something that you might not think of are watches, right? Sometimes if you buy a really expensive watch or like not a name brand watch, like a Rolex or something like that, and you know how to find watches like that, your Rolex can go up in value over time simply by buying it, right? It's going to appreciate almost instantly, whereas your car, if you're buying a car normally that's not exotic or one that's not in this specific example, will obviously depreciate the moment you drive it off the lot. So just trying to expand your mind. If none of that makes sense, it's totally okay. I just wanted to give you different examples. Now, obviously there's real estate as well, and there's plenty of other examples, but I personally don't know that much about real estate myself, so I'm not going to pretend that I do and give you advice on it because I don't know much about it. I'm a stock guy. Real estate's something I potentially want to learn a lot more about. I'm reading books on it. I'm taking courses on it, but I am still a novice when it comes to real estate, so I won't recommend that you do that personally, although clearly a lot of people have made a lot of money in real estate. But I clearly, and it's obviously a great way to go if you know a lot about it yourself, or if you have a partner that knows a lot about it. But I would recommend only invest in things that you know a lot about or that you can obviously help alter or control the outcome with. So, learn a little bit about real estate if you want, but I personally like blue chip stocks, ETFs, and mutual funds. You're obviously your retirement account, and then I go a little bit into bonds here and there.